Felix and Winston here on the way to the beach, but the big story of course is rate hikes, and there is a significant risk here the market will be surprised. Why? Well, let me run you through the numbers. So the Fed fund futures have a 70% prediction that there'll be no rate hike. Is that good? You might be thinking, yeah, it's great. You might be thinking, almost as great as the Ferrari pile up here behind me. There's another one. But no, it's unusual. Normally, 3 days before a rate decision, we have a 90% take by the market on which way it's going to go, which kind of leaves the potential risk that we might get surprised. Monaco Beach Club behind me here, which is lovely, and a pile up of Bentleys. So what decides this, and which way is it going to go? How much is it going to impact the market by? Well, okay, what decides this? Well, you get inflation data out on Tuesday. That's really important. And then on Wednesday, I'm actually less bothered about whether or not we get a rate hike on Wednesday. I'm much more interested in whether or not the economic forecast of the Fed uses terms such as, you know, employment has peaked or growth has peaked or that sort of thing, indicating that we might be heading into a slowdown and that they recognized it, and that therefore this is the end of the cycle. So I would say there are two outcomes here that are likely. We get a pause on Wednesday, and they simply then keep interest rates at 5% till the end of the year. I think that's what the market is essentially betting on, and therefore like the kind of base case. Beautiful hotel here behind me, and again lots more cars up there. So we're walking to the beach. The slightly less positive case for us stock investors is rate increase one or two more times, so another 0.5% possibly, and that could be either on Wednesday or in July or the following one. And you guys who are long-term investors, doesn't really matter all that much, and you're still then going to get to the end of the year or early 2024 when rates start to get cut. Why would that happen, and why would my base case, which is more of a bullish case, be the more likely outcome? Well, it really depends fundamentally on what inflation numbers do and what jobs numbers do. And we've talked quite a lot about, as a friendly little one, bonjour. We've talked quite a lot about how job numbers are heavily manipulated, and the Fed knows that. They're not stupid, right? I mean, you might think that they are, printing 40% extra money and then raising interest rates at the fastest rate in human history might make you think that they're a bit daft, but they're not that daft. So they know that the labor market isn't quite as glorious as it looks. It's mainly part-time jobs. It's mainly people working 2 or 3 jobs because they're not getting enough exercise and they're therefore huffing and puffing upstairs. There's a nice house behind me there. See that? That's a nice Villa Vigli. So my thought here is, if we get a surprise, the Fed wants to kick the stuffing out of this rally, and they're not going to like this rally, because this rally undoes their good work. It eases financial conditions. I get an email every week from the Chicago Fed, and every week it says financial conditions have eased. They can't be enjoying that because we're undoing their good work. The more the market goes up, the more wealthy people feel, the more they spend, the more the economy grows, the more inflation we have. So now that is good news for the Fed. That's a nice one up there too. Can you see that? Hang on, where is it? Up there. Yeah, that's a nice one. So property porn at the same time. So they have an interest. If they're really worried about inflation not coming down quickly enough, they could give this market a kicking. The other thing, and that's always my conspiratorial side, is that this Fed president is a Republican. Now elections are coming up. How do you make sure a Republican gets elected? He's a card-wearing, card-bearing Republican. How do you make sure that happens? Well, you keep interest rates higher for longer, you crush the economy. No president ever gets elected in a massive recession and mass unemployment if they have perceived to have caused it. So that's a thought. But for me, the likely outcome, what I'm kind of betting on in a sense, is no rate hike this month, and we then either get another quarter point or even 2 more quarter points after that. But likely I would just say they're going to keep the rates flat till the end of the year, and nothing will happen. It'll slowly but gradually break the US economy. It'll slowly and gradually cause unemployment and companies to fail and people to delinquent, if that's a word, on their credit cards, and we're seeing all of that. All the data is already there, it's just no one's paying any attention because the view is just too beautiful, isn't it? It's just spectacular here in the south of France. What do you think, Winston? Any final thoughts, Winston? He's just thinking, can we get out of this heat and go into the water? I think that's pretty much it. So yeah, honestly, like, pay attention to Wednesday. If you've got big trades open, exiting them on Tuesday or on Wednesday before, I think it's always a smart move because you de-risk, and that's really what it's all about. Making money is about taking less risk, not more, and I think people don't often realize that. So all I ask is, you know what I'm going to say? Smash the subscribe button, guys. Speak soon.